Hello everyone, let's embark on the first steps of our trading journey. Let's take those initial steps in trading together. First, let me say that in the financial markets, there are numerous methodologies and perspectives. And precisely because of this diversity, it gives rise to a wide range of terminologies and different names for the same concepts, for the same phenomenon or event. One trader might call it one thing, while another trader calls it something else. As a result, these terms and names can sometimes cause confusion for others, but often, the core essence of it is fundamentally the same. So, I will explain everything, based solely on its core essence, okay? When you sit down to trade, or to analyze a price chart, the chart you see on your screen looks something like this, right? What you're looking at is the entirety of a downtrend. And what you see on your screen is essentially received passively by you. Whatever appears on the screen is what you see. But when you trade with a chart like this, it's not guaranteed that you've seen the entire downtrend like this. You might zoom in and only look at the final part of the downtrend like this. You focus only on this part and analyze, then trade based on that. Focusing too narrowly like this can sometimes lead to certain mistakes when you assess and analyze the market. When I make a video for others to watch, I certainly can't let the screen look cluttered. For a video, it needs to be a bit aesthetically pleasing, clear, and intuitive. So, I often zoom in to make the candles larger, to ensure the chart looks balanced, just visually appealing enough, but also conveying enough information to express what I want to say. To communicate effectively, I often zoom in to make it as reasonable as possible within the frame of the screen. But when you trade, you need efficiency, not aesthetics, because no one else is watching. It just needs to be functional. If you zoom in like I do, sometimes zooming in too much can lead to missing the bigger picture, resulting in flawed analysis. So, the first thing, when identifying a trend, if possible, try to view the entire trend on your screen for the best results. If the trend is too long, and viewing it entirely on the screen makes it too small to see clearly, then viewing it like this is fine too. But avoid zooming in too closely, okay? Although I've mentioned before that we trade based on what's closest to us, but zooming in too close like this is not ideal at all. And that's the first thing to note when we look at any price chart. So now, we have a downtrend. What's next? The next step is to identify the key level in this downtrend. The key level is critical. A key level is the last point where there was significant buying pressure in an uptrend, or the last point with significant selling pressure in a downtrend. What does significant mean? To me, significant means the price was pushed strongly far away from the previous high or low. I often call this a true breakout. On this simplified chart, this is what's called a key level. This is the last point where the strongest selling pressure pushed the price far away from the previous low. Easy to see, easy to understand. So, on this chart, how does it work? It's a bit trickier. So, where is the key level? This is the key level. And it hasn't shifted lower yet, okay? I'll leave this part unexplained for now. If anyone watching doesn't understand yet, rely on the definition above and then reason out why this point or that point isn't the key level, okay? Okay, back to the simpler chart. So, this is the key level, and this is its previous low. So, why do we need to identify the key level? What's the purpose of identifying the key level? By definition, the key level is the last point with the strongest selling pressure in a downtrend. Because it's the point with the strongest selling pressure in a downtrend. If the price breaks through this level, breaking through the point with the strongest selling pressure, it means the downtrend has reversed into an uptrend. But if you believe the downtrend will continue, then placing a stop loss behind the key level, behind the point with strong selling pressure, gives you more confidence. That's the significance of identifying the key level. But even if you identify it correctly, you don't just place a trade immediately. How to handle it in detail will come step by step. Don't rush, don't be hasty. I'll clarify it gradually in the upcoming videos. In this video, I'll focus on one specific case to help you understand, from which you can derive a trading approach and how to place trades in that scenario, okay? This is the entire downtrend. Now, let's analyze this downtrend step by step, bit by bit, okay? First, let's start from the beginning. Analyze from the start. Suppose at this point in time, we don't yet have the later part. The price has only reached here, so, at this moment, where is the key level? Where is the point with the strongest selling pressure in this downtrend? Is it here, here, or here? This is definitely not the key level. The price has just barely broken through the previous low, so we can't confirm anything yet. So, is this the key level? No, it's not. Recall the definition of a key level. A key level is the last point where strong selling pressure pushed the price far away from the previous low. And this is the previous low. The price just barely broke through, but then it reversed back up like this. So, this is not the point with the strongest selling pressure, and this is not the key level. Similarly, this is the same. This is also not the key level. So then, the key level in this chart is still up here. This is the key level. And currently, it's also the starting point of this downtrend. Suppose at this point, the price surges strongly upward, and you still want to look for a selling opportunity. Then, we only look for a selling opportunity when the price returns to this level. To make it clearer and easier to understand, I'll represent the downtrend again. On the chart, a simplified chart, okay? This is the simplified chart of the downtrend. So, this is the key level of the downtrend. And this point here, where it moves in a choppy manner like this, I often call it a staircase movement. Why is it called a staircase? Simply because I see the price moving like steps on a staircase. So, that's why I call it a staircase movement. And remember, in this staircase area, there's no point with selling pressure strong enough to be called a key level. The key level is still up here. The price is moving choppily in a staircase pattern. It moves choppily until here, then drops sharply downward. It drops sharply, then continues moving choppily. So, this point, where it drops sharply, I call it the key level. And this point is called its previous low. When you first look, you might feel a bit confused by this area. So, I'll represent this entire area on a simplified chart, okay? The price drops sharply downward, then moves choppily in a staircase pattern. While moving choppily, it drops sharply again, then continues moving choppily. So, this point is called the key level. And this is its previous low. Okay, back to the chart. Now, everyone, look closely at the segment where the price breaks down, forming this key level. Look closely here. See how the price breaks through the previous low with just one candle. With just one long red candle. After that, the buyers try to push the price up to at least retest this previous low, then it moves down. But the buyers only manage to push the price to this midpoint, not reaching the previous low before dropping again. Now, let's check it on a smaller time frame, okay, to be more certain. On a smaller time frame, the story is similar. The price breaks through the previous low in one move, with just one long red candle. After that, There's no buying pressure strong enough, no candle or wick that can reverse back to retest the previous low. It only reaches here and then drops like this. To sum it up, this is the key level. And the fact that the price breaks strongly like this, forming this key level, is an extremely strong breakout. This is the strongest breakout I know. As I mentioned in previous videos, I've drawn this large price zone, called a candle cluster, not used correctly or fully, but that's just terminology. The essence of it is simply this: breaking through the previous low with an extremely strong force like this, with no buying pressure, or counter force strong enough to retest the previous low. Thus, this is an extremely strong selling zone, and I'll repeat, this is the key level, and this is the previous low. And from the fact that the price breaks strongly like this, it leads to three consequences. The first consequence is that in this case, there will be no stop hunt at the key level. The key level means that if this downtrend continues, the price cannot break through the key level. But if the price does break through the key level in any way, it's not a stop hunt phenomenon, it's a breakout. The downtrend reverses into an uptrend. Remember, the first consequence: no stop hunt at the key level. The second consequence: if this downtrend continues, the price may pull back to the previous low and then drop. Or it may pull back to the key level before dropping. That's the second consequence. The third consequence: if you predict that the downtrend will continue, then you can confidently place a sell limit order early in this case. In this scenario, place the stop loss here, as there's no stop hunt, and take profit below. This isn't something obvious, okay? In many cases, we predict the downtrend will continue, but we can't place a limit order. Instead, we have to wait for confirmation, but in this case, we can place an early limit order in this scenario. And these are the three consequences that occur when there's a strong breakout like this. Continuing from these consequences, if you predict that the downtrend will continue, there are three common ways to place orders. The first way: place an order at the previous low, stop loss just behind the key level like this. Take profit below. The second way: place an order at the previous low, stop loss here. Assuming it only pulls back to the previous low, take profit below. If this order loses, place another order at the stop loss level, but with the stop loss behind the key level, and take profit below. The third way: place a single order here, in the middle. Stop loss behind the key level, take profit below. These are the three ways to place orders. You can choose any of these, but each has its own advantages and disadvantages. For the first way, this is the method I usually use most often. I always place orders like this. Its advantage is that it's easy to get filled and safe. Its disadvantage is that the risk to reward ratio isn't very high. The second way, placing two orders like this, has the advantage of being easy to get filled and offers a high risk to reward ratio. But its disadvantage is that if it loses, you'll lose two orders consecutively, which means losing a lot of money. This second way is for those who prefer aggressive trading over defensive. Aggressive trading can yield big wins, but losses can also be significant. The third way is safer, with a high risk to reward ratio, but the downside is that you might miss the trade, because the price might only pull back to here and then drop. For me, I recommend and usually use this first method. I always place orders like this. If the order has a 1 to 3 risk to reward ratio, I place it. It's as simple as that. But of course, we can't rush. We can't just place orders like this without knowing whether the downtrend will continue. We need to be certain that the downtrend will continue before placing such orders. If it doesn't continue, how can we confidently place orders like this? to know if it will continue. We simply check the steepest point here. This lowest point. What is it? By dragging it to the left. Check the price to the left. You'll see it has reached the starting point of the previous uptrend right here. This uptrend even surged strongly upward with long green candles like this. So, this is likely a strong buying zone at this moment. Unfortunately, we can't predict whether this downtrend will continue. And now we're stuck between a strong buying zone and a strong selling zone. And in theory, placing orders at this point is more about luck than skill. Buying or selling could both win. Of course, with luck involved. We won't place orders now, we wait. We wait for the price to break upward or downward before we buy or sell, then we proceed with trading. Finally, the price breaks upward, breaking through the key level. As I mentioned earlier, in this case, there's no stop hunt at the key level. So, with the price breaking like this, it means it breaks through the key level, breaking through the strongest selling zone. Thus, the downtrend has reversed into an uptrend. At this point, we can look for an opportunity to buy. So, now let's clear all the old data and focus only on the new uptrend. So, in this uptrend, where can we buy? Here? Or here? Looking here, it's clear that this point is not the key level, obviously. But it does have strong buying pressure like this, with long green candles like this. So, let's check it out, okay? This is the low, the most recent high. The price breaks through this high. And if you look closely here, the price breaks through and reaches here. Then the sellers push the price down, forming a candle wick. The price returns to the previous high, then continues to rise. This is completely different from this point, okay? Here, the price breaks downward in one move, but there's no buying pressure strong enough to push the price back to this previous high. But here, it's different. It's strong enough to push the price back to the previous high. Thus, this buying pressure is strong, but not extremely strong, not ideal, not great. Plus, this isn't even the key level. So at this point, there's no factor supporting a buy order. Eliminate it. And in this case, we can only buy here. This is the key level of the uptrend, and at the same time, it's the starting point of the trend. There's no other place where we can place a buy order. The safest option in this case is here. If I were advising others at this point, I'd recommend waiting for confirmation buy. Waiting for the price to drop down to this price zone, then reverse into an uptrend, and only then should we enter the trade. That's the textbook approach. The way I'd advise others. Or you could wait for additional confirmation with a reversal candlestick pattern when the price reaches this zone. That's the second approach. But personally, if I predict the uptrend will continue, and there's no other place but here, I'd place a limit order right now. Of course, there's a high chance of a stop hunt. So we must place the stop loss far enough below to avoid the stop hunt, and take profit above. to the starting point of the previous downtrend. Why don't I wait for confirmation, like what I advise others? Because with my trading style, I prefer to predict where I can place a limit order and do it immediately. Here, there's no other place to place a limit order, only this one spot, so I place a limit order. Of course, if you want to be safer, you can wait for clearer confirmation. This trade has hit the take profit. Although this trade hit the take profit, it's worth noting that in many cases, the wick here can be very long in some cases, plunging sharply downward, causing our stop loss here to still get hit by a stop hunt. So, waiting for confirmation has its benefits that we should learn. That's the main content of this video. In this video, I've tried to explain a specific case in detail, to provide a trading approach, and how to place orders appropriately. If you think about it, there are only about 2 or 3 major cases left, not many. Easy to remember. As for smaller cases, they're just derived from these major cases. I'll try to think and explain in the simplest way possible, cutting out unnecessary details, using as few terms as possible. But I also need to emphasize and clarify the purpose of this video series, which is to focus more on helping you understand the market, what the market is telling you, so you can develop your own trading approach. From there, you can create your own trading rules. Based on my experience, that's what's important. Because from there, you start forming your own entry rules, my entry rules. And how I handle this case, I've already explained. But that's not my main focus. I don't want you to follow my rules exactly. I want you to understand the market through my perspective, through my stop losses, take profits, and miss trades. From there, I developed my own rules. Your experiences, your take profits, stop losses, and miss trades are different from mine. So your rules can't be exactly like mine. Each person needs to understand the market themselves and create their own trading rules. That's how you can trade sustainably. And that's everything I want to say in this video. That's all I want to convey. Goodbye, everyone. See you in the next video.